Hey everyone, welcome back to Corporate Decoder, the place where we dig into the documents companies file with the government. Today, we're looking at a filing from inTEST Corporation. Don't let the name fool you, it's not about stress tests, but it's about testing, and we're gonna figure out if their financial health is passing the test. inTEST Corporation filed this report with the Securities and Exchange Commission on March 7, 2025. These filings are important because they give us insight into what's going on inside a company, straight from the source. Think of it as peeking behind the curtain, but with permission. The company released its financial results for the fourth quarter and the entire year of 2024. This is a big deal because it tells us how well they did financially. Were they profitable? Did their sales go up or down? This is the meat of the report that investors are watching closely. Now let's talk about the top executives. The company decided that the CEO, Richard Grant Jr., and the CFO, Duncan Gilmer, will keep their same salaries as last year. Instead of a regular raise, they're getting stock options, which means they have the opportunity to buy company stock at a set price. The idea is to motivate them to make the company perform better because if the stock price goes up, their options become more valuable. The company also set targets for their short-term bonuses for 2025. These bonuses are based on how well the company performs. If they hit the targets, the executives get a bonus, but if they don't, they might get less or even nothing. They also approved long-term incentives awards, with the value divided to be 1, a 4-year time vesting award, 2, a 3-year performance vesting award, and 3, an award of stock options. The performance metric will be the percentage of revenue received by the company generated by recurring revenue streams for the year ending December 31, 2027. Here's something interesting: the company is renewing its plan to buy back its own shares. This is called a share repurchase plan. Basically, the company can go into the market and buy its own stock. This can be good for a few reasons. It can boost the stock price because there's more demand for the shares. It also reduces the number of shares outstanding, which can make each remaining share more valuable. The company has about $9 million to use for these repurchases, but they don't have to spend it if they don't want to. They can stop or change the plan at any time. The company also put out a press release talking about its financial results and the share repurchase plan. Companies often do this to give investors and the public a summary of the key information. Let's dive a little deeper into the financial results in the press release. I'm scrolling down so we can take a look at the numbers. Okay, here's a summary of how they performed. For the fourth quarter, their revenue was about $32.1 million. However, they had a net loss of a little over $1 million, or $0.08 per share. Now, for the whole year, their revenue was $129.7 million. But they reported a net loss of $3.7 million, or $0.30 per share. So what does all this mean? Well, the company had a good amount of revenue for the year, but they didn't make a profit. They actually lost money. This could be due to a number of factors, like increased costs, investments they made, or changes in the market. Here's a chart of the geographic revenue breakdown. China represented a little over 10%, the United States almost 60%, other international the remaining 30%. This is important to see where they make most of their revenue, which can inform us about how global events might impact them. inTEST sells into primarily 3 markets: semiconductor, electric vehicle or EV, and the military government sector. They appear to be trying to expand into life sciences as well. So let's step back and look at the bigger picture. inTEST is in an interesting part of the technology market, testing. This means they rely on other industries like semiconductors and electric vehicles to do well. Their revenue did pretty well for the year, almost $130 million, but the net loss is a red flag. They need to figure out how to turn that revenue into profit. The decision to keep executive salaries the same but grant stock options is interesting. It suggests the company is trying to be careful with cash but wants to motivate its leaders to focus on long-term growth. The share repurchase plan is a potential positive, but it depends on whether the company thinks its stock is undervalued and a good investment. One thing to keep an eye on is their expansion into new markets like life sciences. This could be a big opportunity, but it also comes with risks. They'll need to invest in new technologies and relationships, and there's no guarantee it will pay off. Overall, inTEST is a company with potential, but it needs to focus on profitability. They're in a good industry, but they need to execute their strategy well to succeed. They need to show that their product is not just a good idea, but that it can consistently make the company money. Thanks for watching. If you found this breakdown helpful, please like this video, leave a comment, and subscribe for more deep dives into the world of corporate filings. Until next time.